Welcome back to the Property Trio, the podcast for the sophisticated property buyer. I'm Kate, and as always, I'm joined by Mike and Dave. This is the third episode in our borrowing capacity series where we continue to unpack the key factors that determine how much you can borrow. And more importantly, how you can take control of those levers to boost your borrowing power so you're not caught off guard by borrowing capacity that's lower than expected simply because you are naive to the rules of the lending game. In our previous episodes, we've explored everything from managing living expenses and the impact of dependence to how interest rate movements and different types of income can influence your borrowing capacity. If you haven't already, we definitely encourage you to go back and listen to those earlier episodes. Today, we're diving into how lenders assess your existing debts, from HECS to car leases to mortgages, credit card limits and more, plus the strategies you can put in place to lift your borrowing power. We'll walk you through examples to show you just how much of a difference these steps can make. So, without further ado, we're jumping in. Dave, you've prepped a lot of today's show notes and I'm really excited about this one.
Yeah, well, shout out to my staff. They've done most of the heavy lifting.
You're not meant to say that. And Mike, you're on point. You're ready for a bit of credit activity today, aren't you?
Yes, I'm living all my life on credit these days. Hell of a rush. Really upsets the banks though. So let's talk about what upsets them the most. Credit card limits are something that I've been bitten by before, especially when you look at things like Amex. That sometimes it's a mystery as to what the actual limit is, but that can certainly count against you. But little things like small personal loans, car leases, any money owing to the ATO, just mentioning for a friend, anything like Afterpay or those kind of payday lender things, they can get it very nasty. I think we should probably have a whole other episode on why you shouldn't use them, but if you do, the banks will certainly zero in on that. HECS is a big and fairly obvious one as well, and then of course just your existing home loan and investment loans. They're probably the major ones.
Yeah, well, you've given us the overview for many things that can be tweaked, but I always stand back and marvel at strategy that a strategic mortgage broker can walk you through when it comes to understanding which levers are the most powerful. And obviously everyone's scenario is different, but that's why we have Dave here. Let's kick it off with credit cards. How does the lender assess these, Dave?
Yeah, so look, as Mike's just touched on a number of those different types of debts we can have. And the thing is that lenders don't assess just what your repayment is. They often will look at put a buffer on the interest rate. So with mortgages, they'll put a buffer of 3%. So how much they actually impact your borrowing capacity is much greater than the actual debt you have. And that's one of the things we want to get across to everybody during this episode. And so we're going to do it, through these different types of debts, and then how you can put in place strategies to make it work for you and improve your borrowing capacity to buy that property or, access that equity to renovate and invest. So with credit cards, it's certainly one of the ones that surprises people a lot. Lenders will assess credit cards based on the limit, not the balance. We often hear our clients say, but I don't even use that credit card, but I pay it off every month. And guess what? That unfortunately doesn't matter.
So Dave, if we take, if you'll indulge me, if we take three scenarios, right?
I love indulging you, Mike. You know
You've made a career of it on this show, at least, Dave. Three scenarios. You've got someone who's got a credit card, let's say 20 grand bill. They only did it for points and they bought a washing machine and they got their 100,000 Qantas points or whatever. They paid it off and they've cut it up, right? But it still kind of exists somewhere.
Yeah.
You've got another person that has flogged it to within an inch of its life and is now owing that 20 grand debt. And then you've got the person that you mentioned before that uses it for their ongoing, but they pay it before the interest is triggered and it's just kind of a utility thing. In the eyes of the bank, it kind of seems like no one's in an advantageous position, even though there's different stories about the responsibility of the credit card recipient.
Yeah, look, it's a really good way to sort of spell it out to our listeners, Mike. So all those three people, it will impact their borrowing capacity exactly the same way, because it's simply based on the limit. Even though one's fully drawn, one, cut it up and doesn't use it, and one uses it every month and pays it off. It's the potential ongoing commitment that the bank's looking at. So think of it like, if a business has an overdraft, they can always draw up onto that overdraft. And that's the way credit cards and anything where you've got a facility that you can access finance, that's how it's looked at. So most lenders apply an assumed monthly repayment, which is usually around 3% of the limit. So in the case of a 20,000 credit card, they're factoring in a $600 per month liability, even if you've never actually spent that much on your card. And that really can chew up your borrowing capacity, as we're about to share with you.
Yeah, thanks, Dave.
Yeah, so Dave, if your borrowing capacity is lower than what you feel you can afford to borrow, it might make sense to reduce the limits on your credit cards. But can you illustrate for us how this looks?
Yeah, so my team, as I lifted up the curtain and shared with the listeners before, they ran the numbers for us, and the results are pretty eye-opening. So each reduction of $5,000 to your credit card limit will boost your borrowing capacity by roughly $23,000. So if you have an 80% loan-to-value ratio, that'll actually translate to an extra almost around $30,000 in purchase price. So reducing a 20K credit card limit all the way down to, say, 5,000. Let's say you generally don't spend more than 3,000 or 4,000 on it each month, so you actually don't need that 20, but you want to keep it. That would increase your borrowing capacity by $70,000.
That's massive. Would a lot of people understand that? I mean, obviously you're having these conversations, you and your team, every day. Do people realize how big it is?
No, they generally don't. So it's as you can imagine, it's one of the first things that the team will talk with our clients about when we're talking them through where their borrowing capacity sits, and if they need, if they need to lift it and feel like, they would like to borrow more and it would be affordable, but at the moment their borrowing capacity is limited because of things like this. Often it's very common.
Yeah.
So, and in this example, if they don't actually use the card and they're in the position to close it altogether, so if you just close that 20,000 limit credit card, your borrowing capacity would be increased by about $93,000. And if you had looking to buy a property and you had an 80% loan to value ratio, and assuming you had the extra cash to fund the difference, I mean, that's another $115,000 in purchase price. So, yeah, it's one of the simplest and most effective levers you can pull if your borrowing capacity is tight.
That's a massive one. Thanks for sharing that, Dave. I think there's a lot of light bulbs hopefully going off with people. But let's put that in perspective. In our last episode on borrowing capacity, we mentioned that a 0.25% drop in interest rates would boost borrowing capacity by about 18 grand for a single earning 150 a year, or 35 grand for a couple with a combined income of 300K. So trimming back your credit card, or better yet, closing it, can actually have a similar or bigger impact than waiting for that next rate cut. It's so interesting, the focus that investors have on the rate cuts. Let's hope they're not the same people that are zeroed in on that, but have $100,000 credit card debt. But of course, it's a much faster way to hack your borrowing capacity is to minimize those limits or cut up those credit cards rather than wait for the next interest rate cut. And you've actually modeled this in quite a lot of detail, or perhaps I should say your team, Dave, and we can share that in the show notes, I'm guessing.
Yeah,
we'll put those examples in the show notes for.
Yeah, the show note genie will sort it out.
Excellent. Thanks, Kate.
What about personal loans and commitments, Dave? So let's say someone took out a car loan for 50 grand 2 years ago, and they've made their ongoing repayments and the balance is now down to, let's say, $30,000. Can they reduce some of that debt maybe by paying off an extra 10 grand to improve their borrowing capacity? What would you say about that scenario?
Yeah, look, Kate, it's a common question, and the short answer is no. It doesn't improve your borrowing capacity by paying down, a car lease or a personal loan with a lump sum. So, in essence, partially paying down a loan won't help you increase your borrowing capacity one iota. So,
Wow.
yeah, which again is just a bit of can be a common misconception. Sometimes people can make decisions in advance of meeting with their strategic mortgage broker and they're not helpful, but it's too late to unwind them or.
Yeah, I'd love to go back to the finance people. Can I have that 10 grand back?
Yeah. So a lot of, personal loans and leases and those types of things won't allow you to redraw it back. So so the loans are assessed very differently to credit cards. So with the credit card, as we touched on, lenders look at the limit. So reducing that limit will improve your borrowing capacity. But with personal loans or car loans, they're looking at the actual monthly repayments you make.
That sounds like the banks being the fun police again, Dave. So if we've got, let's say...
I think that's their job, isn't it?
Yeah.
Just be the fun police.
Big shout out to the financiers of this great nation.
No more Wagyu and Shiraz.
No, certainly not on...
said to Westpac.
Yeah, certainly not on credit, Dave.
That's right.
So if you've got 30K left on your car loan and you're having to pay $950 a month, you chuck them 10 grand, they're still going to say, well, your commitment is still $950 a month until it's repaid. So I'm guessing if you throw 10, it just reduces the term. The banks should favour it some way, or is it really just about the current ongoing commitment?
Yeah, so look, it's your current monthly repayments they look at. So you might be repaying that loan in 6 months' time, but your monthly repayments are your monthly repayments. So that's what lenders will look at. So yeah, from a lender's perspective, that $950 monthly commitment is still there, so it continues to impact your borrowing capacity, even though you chuck that 10K lump sum to pay down your debt. And HEX is another one that a lot of people get caught out on and don't realise how it's impacting their borrowing capacity. So again, HEX, it doesn't matter if you lump sum, pay some down, other than you're going to pay it off sooner. But in terms of it's because the repayments on HEX is linked to your income levels, that just determines whether you still owe 10 grand or 50 grand on your HEX. It doesn't matter. It's what your monthly commitment to HEX is that impacts your borrowing capacity. So it's a really important point to highlight to our listeners. So in short, to get any borrowing capacity benefit, you need to pay out the loan in full. And so that we'll talk through now a bit about how that can happen through refinancing or debt consolidation. We'll come to that.
Yeah, so to actually improve your borrowing capacity, in short, you have to close the loan through either of those means.
Yeah, and that's when the repayment drops out of the equation, so your borrowing power gets a real boost.
And you know what? It's the same as a home loan.
Yeah,
whether you just make a big lump sum payment or not, it's the obligation that you carry, the minimum obligation each month, and it's because you've got a fixed term loan. And we're coming up to. I love the concept.
You could have 200,000 in redraw. It doesn't matter because you've got your minimum monthly commitment. So it is the same as home loans. But I think because personal loans are generally smaller debts, people expect a lump sum payment to have an impact, but it doesn't.
Yeah, not unless it's the entire debt, huh?
Yeah.
So can you illustrate for us how paying down that debt in full would improve borrowing capacity, Mike?
Yes, thanks to Dave's team, I definitely can answer that question, Kate. And to summarise that point, like don't chip it down unless you're chipping it out of existence, is what I've really picked up. I probably ruined my gold nugget. That would have been a clanger. But if we look at Dave's team's numbers, so the average amount people finance a car for is around 47 grand, and the most common term is a 5-year on whatever interest. The current average interest rate sitting about 7.56, quite a precise average number. So shout out to the team again.
I thought I'd throw that in there.
Good.
They're not rounding numbers up, are they?
No,
my
they are
team.
not.
Yeah.
No, I love that. As an analytical person, that hits me right in the feels. But that'll work out to a monthly payment of $943. So if someone's making those repayments for 2 years, the balance remaining on that loan would typically be just over $30K, similar to the scenario we went over before. If you pay out that car loan in full and remove that $943 impost monthly commitment from your financial profile, the impact on the borrowing capacity is massive. So for a single applicant, it increases borrowing capacity by around $170,000, and for a couple, it jumps by $190K. Those numbers would be pretty similar regardless of your income, because what you're doing is removing that fixed monthly debt commitment, and that has the same impact on borrowing capacity no matter how much you earn. So those are big biscuits to be playing with.
It's a startling number, isn't it?
Yeah, it's a. So just to summarise that for our listeners, you have this car lease, and if you can find a way to pay it out with monthly repayments of $943, your mortgage borrowing capacity will increase by $170,000 to $190,000. It's a big number, isn't it?
That's huge.
Yeah.
So while it might feel like a big hit to pay out the loan before purchasing or accessing equity to renovate or invest, that upside, particularly if you're trying to stretch into your next property, can be really significant.
Yeah. Well, Dave, let's talk about the considerations then for when you're looking at closing out your debts.
Yeah, so look, for our listeners, there's definitely a few things to weigh up before you rush off to pay off debts just to boost borrowing capacity. The biggest one is your savings position and how paying off the debts will affect the cash you'll need to complete settlement on the property you plan to buy. You also need to consider what kind of cash buffer you'll have left over, obviously, after the purchase or refinance. So, for example, if you've got $50,000 saved, and let's say you might be willing to use $30,000 to pay out a car loan to boost your borrowing power, that's only going to leave you with $20,000. And if you're looking to purchase a property, that may not be enough to cover settlement costs or allow for a post-purchase buffer, which probably isn't going to cut it for most people looking to purchase, unless they have a high loan-to-value ratio in terms of that small savings buffer or a low purchase price. So maybe a first home buyer can get by with $20,000, but not many people will. On the other hand, if you've got, say, $100,000 in savings and you're looking to pay off a $10,000 debt or a $30,000 debt, then that might be more achievable. So, so we'll go through some of the factors to consider before you make these kinds of decisions.
Yeah, great. It sounds like it really needs to be assessed on a case-by-case basis though, Dave.
Yeah, that's spot on, Kate. So, look, probably the key factors that you need to consider before making these types of decisions and working through with your strategic mortgage broker is, okay, if you're looking to buy a property, what's my purchase price? What's my loan to value ratio? How much room do I have to move to pay off one of these debts or consolidate them? What's the size of the debt I'm paying off? How much does it actually move the needle in terms of increasing my borrowing capacity? What is my savings buffer that I'm willing to reduce down to by using this cash to pay out a debt? What are my overall financial goals? How does this decision take me closer to those goals? So, you really need to work through these factors so you can make a fully informed and confident decision. And unfortunately, a lot of people are making these decisions without understanding the impacts positively or negatively, or potentially not sitting down with someone to get the advice.
That's a big one, isn't it? Like, no one should be just listening to this podcast and going, oh, yeah, I'm just going to pay it down because we've kind of elucidated how meaningful it is. But you got to make sure that it suits your tolerance and your risk profile and the goals, right? So holding on to a little bit of a cash buffer, if you've got a bigger portfolio, it might be too risky to whittle that down just for borrowing capacity if capacity isn't a big issue for you. For others, it's a matter of, let's get rid of that because we're trying to make a big jump on the next one. So as you say, Dave, you need somebody to sit down with that's an expert in this to say, look, what you're trying to achieve right now, this is the better outcome for you.
Yeah, that's right, Mike. The best approach is to weigh up how much extra borrowing capacity you're actually gaining and compare that to what you're sacrificing in terms of your financial safety net. Sometimes the payoff is worth it, and sometimes it's better to keep the status quo. It's really critical that you do not make these major decisions that can change your financial position, like paying out debts, before speaking with a strategic mortgage broker and really being clear on those trade-offs.
And I'm guessing that goes for taking on new debt as well, Dave.
Yeah, absolutely right, Kate. One tip for anyone thinking about buying property, but also eyeing off a new car, if you can wait until after you've secured the property before taking on a car loan, wait. It gives you much more room to move with your borrowing. This particularly applies to first-time buyers. Often you'll sit down with a first-time buyer and they will have just bought the new car, and then the next step was the house, and the car and the car debt has set them back, potentially seriously a year, maybe longer, in terms of having the borrowing capacity to buy the property.
That's the thing, isn't it? I think people can be forgiven for setting up a certain flow, like, this year the goal is we've really got to upgrade the Tarago because that's going to need a new engine. We'll get that squared away, and then we'll go and see our broker about, upgrading the home or buying the first property. We were kind of talking the other day about my life insurance policy. I got that squared away before I got a motorbike and a pilot's license, right? So it's like, get the main bit of debt that you're chasing first, and then, shove all the stuff afterwards, because the bank can't really do much to you after then, right?
Yeah, no, that's exactly right. Like, they
Crudely
might be
put,
putting
but
the
it's
horse
great.
before the cart, but get the house, then the car.
Yeah.
Upgrade the home, then get the fancy car on the lease through the company.
At a disgusting rate for 11-year term.
Yeah, exactly.
It's very important to say that this is not financial advice. You should seek.
Don't listen to Mike.
And it's probably not bad advice. Get the house before the car loan,
Good. I'll have that in writing. Thanks, Dave.
Yeah. Just quickly on that, like, a lot of people seem to think that their car lease, when it's done through the company, like a novated lease or what have you, doesn't impact their borrowing capacity, but it does. It's still a commitment. It's reducing your take-home income. The lease payments are still the same, even though there are some benefits of, doing it through your employer. It still significantly harms your borrowing capacity. And that's one that I think people underestimate, as we've sort of spoken about through this episode, how much that impacts your borrowing capacity. So it does also, even if you've got a car lease through your company.
Yeah, well said. Mark, I've got a question for you. I'm nervous asking you, but let's go. Let's say you're not in a position to take $30,000 of your savings out to pay the loan down. Are there any other options?
Yeah, well, thankfully there are, and we've talked about the ideal situation, but there are all sorts of things that can be massaged, and that's where people like Dave and his team are so crucial if you're trying to get your first home or build a portfolio. So you could refinance or restructure an existing loan. So some lenders may allow you to refinance or extend the term of your existing personal loan or car loan. The same goes for refinancing a home loan. So that can minimise or let's say decrease your monthly repayments, and we can see in the show notes the difference that makes. The result of refinancing is that those repayments will drop, of course. It'll extend it over a longer time period. So again, there is a double edge to this sword, but if we're just talking about the capacity, then that could be a really interesting way to go. Of course, you can lock it in as at a lower interest rate as well, which can minimise those repayments. Another option would be to look at some other debts. So we talked about debts like Afterpay, or let's say a credit card with a 2K limit. It might just be easier to clear the debt on that or remove it if you're not using it, especially especially if any of that debt is attracting high interest rates. And I couldn't tell you what the afterpay interest rate limit is, despite being silly on this show. I'm not so silly to have that facility, but I'm assuming it's pretty high. Close everything altogether if you're not using them or not needing them. You might kind of think, oh, it's good to have that credit card there for an emergency, but if you are seriously looking at your borrowing capacity and you're hitting your head on the ceiling, you need to kind of weigh that up. Eliminating even one monthly commitment can also help with the serviceability. So the actual booster borrowing capacity will depend on what that monthly repayment is, or the reduction in the payment if the loan is financed. So those are a couple of avenues if we can't go down the line of just of chipping those big ticket items away. What have I missed, Dave?
Yeah, like the great summary, Mike. Yeah, so a couple more options can be, some people will look to use things like just wait until they're due a bonus or a tax refund or some sort of windfall, might be some sort of inheritance, and use those strategically. So, yeah, if you know you're going to get a bonus or one of these types of payments, then you can time that to pay out a loan at the same time as you're looking to potentially get finance approval to purchase a property or refinancing. But, that's, if it's not an immediate option, then, it can be planned for, but depends how far in the distance that is. Also, if you have sufficient equity in an existing property, another solution is debt consolidation. That's where you roll the multiple debts like a car loan, personal loan, or even credit card balances into a single facility, which is often part of your home loan, as long as they're all non-deductible consumer debt.
Yeah, getting into one of my most exciting topics as well. So how would debt consolidation actually work in principle, Mike?
All right, well, let's take an example of a home loan with $750,000 owing. You refinance that and top up the loan by $30,000. That'll bring you from $750,000 to $780,000. And as part of that refinance, the new lender could actually use that $30,000 to pay out and close your existing car loan directly.
Can you walk us through how that increases borrowing capacity, Dave?
Yeah, so when you roll a personal loan like a car loan into your home loan or other mortgage, there is a significant impact on your monthly repayments, as we hinted at earlier. So this is for two reasons. First, you're usually shifting that debt from a higher interest rate to a much lower one. So you're often paying 7 to 12% on personal loans and car loans. Credit cards are even higher, whereas with a home loan, it's probably more likely to be around 6% at the moment. So you're obviously reducing the cost in interest, which reduces your repayments. But the big one is that you're spreading the repayments over a much longer term, as Mike just alluded to earlier. So typically this is 30 years for a home loan, whereas car loan repayments would be a lot higher because they've typically got terms of around 5 years. It can be anywhere, car loans and personal loans, from around 1 to 7 years generally.
So Dave, your car loan repayment, which was based on the original loan amount for the car loan, it's effectively gone from paying $47,000 at, say, 7.5% over 5 years. And after refinancing and consolidating that debt, the new repayment is based on $30,000 at 6% over 30 years. So it's all about that monthly.
Yeah, so that monthly repayment's gone from $943 per month, now down to effectively $178 per month through this process. So you've added an extra $750 to your cash flow by consolidating it into a 30-year loan term. And this is going to improve your borrowing capacity by around $130,000 for the single and about $150,000 for the couple. And again, that obviously can make a big difference to the property you can purchase or anything else you're looking to do.
The devil's advocate, sorry, Kate, the devil's advocate might sort of say, oh, yeah, but Dave, in the old system, I would have been paying off my car in 5 or 7 years, but now I've actually got a 30-year loan term, which sounds horrifying. It sounds like a worse outcome. But can
Yeah.
we sort of think about the opportunity cost of if that difference was enough to buy, say, an investment property, the return on that leveraged investment of cash would actually 100x what the difference is in extending that car loan term?
Yeah, exactly. There's trade-offs and pros and cons, and yeah, we're about to come to those.
I think it's really important to remind our listeners that that 30-year loan term and a significant reduction in the monthly obligation is based on a couple of things. Firstly, the bank looks at a car and it looks at a house very differently. The fact that they're willing to offer credit on such a lower interest rate for a house than a car or a personal loan is all about the security. And some debt is unsecured, which means there's no security. You're just telling the bank you're good for it. You'll obviously pay a lot more for that because there is no security, and that's why personal loans can be so horrendous with their interest rates. But it's also contingent on your house growing in value and giving you that opportunity to access the equity. You can't just go to the bank and say, right, I've got a house, I want to consolidate my debt. It's contingent on those two things. But I think it's fascinating when you look at how banks view security or lack thereof, and it reinforces the fact that property, particularly Australian residential property, is something that banks do consider is a very good security because they'll give you such a low interest rate and they will let you extend your credit to swallow up unsecured debt like this.
Yeah, that's exactly right, Kate. And this example really illustrates that difference and what a significant impact it can have on your borrowing capacity. As I've just touched on with some of those numbers, it can be big bickies if you can consolidate some of those debts and in with a home loan. There's no doubt about that. But there are risks, which we will talk through as well, as Mike alluded to.
Can't wait. Well, Dave, can you tell us exactly how does debt consolidation versus paying out the car loan in full compare from a borrowing capacity perspective for this scenario?
Yeah, so this scenario basically, it's going to make a difference of $130,000 for a single earning $150,000 in terms of the borrowing capacity, and for a couple earning $300,000, the borrowing capacity is going to jump by around $190,000.
So, Mike, what are the downsides to debt consolidation?
Well,
I've teed you up with some of this answer, Mike.
good. Thank you, Dave. Yes, well, debt consolidation can be a fantastic tool in the right situation, but as Dave alluded to, it's not without its downside. So it's important for people to go in with their eyes open. When you consolidate, say, a car loan into your home loan, while your monthly repayments drop, that can help your borrowing capacity. You end up paying a lot more in interest over the life of that loan. So that was where I was sort of devil's advocating you before, Dave, but it's not that simple of just paying more if it sets you free to go somewhere, right?
Yeah, that's right. I mean, if we just go back to that example before, on that 50,000 car loan at say 7.5%, you might pay over 5 years 9,500 of interest. But if that's then refinanced and consolidated into a mortgage, the interest over a 30-year loan term could be as much as $35,000. So, that's at least 4 times as much in that situation.
Yeah, so on top of the interest you've already paid during those first 2 years.
Yeah, so that's even on top of so if that mortgage started at that car loan started at 50,000 and then you've paid it off over a couple of years to 30,000 and then you consolidate it, that's on top of the interest that's already been paid.
Yeah, so even if the interest rate's lower, the much longer loan term means you end up paying a significant amount more in total interest.
Yeah, so if you stay disciplined and pay just an extra $100 a month on that consolidated loan, you could reduce the total interest paid over 30 years from 34,000 down to around 12,000. So that's a significant saving. I guess the main thing to factor in is that even if you do move it across to a home loan, it's on a lower interest rate. You can still keep making additional repayments. Okay. And even though in theory that loan goes for a longer period of time, there's nothing stopping you making additional repayments. Ultimately, you're on a lower interest rate and you determine how quickly you pay things off. But as Mike touched on before as well, what you're weighing up is, well, what is the upside of doing this? Is it allowing me to buy an investment property sooner? Which is going to create a lot more wealth for me over the long run. Is it going to, by consolidating this car loan, going to help us upgrade the home and get into a home that we're going to be happy with forever, versus having to wait another couple of years and the market gets further away from us? So you've got to look at the trade-offs in terms of the benefits of what you're getting by consolidating the debt. And also you've got to understand that at the end of the day, irrespective of the loan term, you control how quickly you pay off your debt.
Exactly.
So, Dave, if we sort of adopt this scenario that we've consolidated the car loan debt, we've got that now extrapolated over 30 years, but a big boost to our borrowing capacity. It's enabled us to go and buy that investment property that we've got some really good prospects for, because Kate and her team found an absolute clanger. Do we need to sort of analyse the individual to some degree to say, okay, well, if they got in a position where they're taking on a car loan, that's maybe a little bit more ordinary and pedestrian, but if we were consolidating things like Afterpay or, a couple of different credit cards in various drawers around the house, is there an opportunity for people to just get that done and then dirty the waters again a little bit more, and we sort of get stuck on this treadmill of tidying things up to go to the bank, we get the property, and then we sort of go back to old nasty habits?
Yeah, look, I think probably the worst examples for people is they don't have the discipline with paying off a mortgage, they rack up some other debts, they consolidate because they've got some equity in their home, and then the same pattern begins. They then start spending more than they're earning. When you factor in the new repayments, then they start racking up more debt. But thankfully, their income's increased, their property value's increased, and they consolidate again. And it can become a bit of a pattern. So, if someone's... And so they're not actually consolidating. They're just consolidating to reduce their monthly repayments. They're not necessarily consolidating to upgrade the home or invest in property or shares or something. So, if someone's consistently racking up debt without changing their spending habits, debt consolidation has the potential to make things worse. Yeah. You might clear your credit cards or personal loans temporarily, but if the underlying behaviour doesn't shift, you can end up with even more debt and less equity in your property down the track. The truth is, if you don't have the tools or discipline to manage your money and keep your spending in check, then debt consolidation isn't always the right strategy for you.
It's so interesting and horrifying as well. When we were prepping for this episode, I had a lot of flashbacks and memories from my life as a mortgage broker. And, debt consolidation can be such a powerful tool to reset things. But you've hit the nail on the head, Dave. The behaviour and attitude towards unsecured or low-value security debt, it has to change. And that money that is freed up needs to be used for something meaningful. And I don't know about you, but in my experience, when I had a customer or client come back for a second debt consolidation, the writing was on the wall.
Yeah, that's right. There's certainly patterns of behaviour in this space, and you have great empathy for those people. And there's only so much you can do. They've ultimately, you can give them some support, empathy, coaching, direction, try and help them set up a better system. But then, it comes down to the individuals because, we're all making choices on a daily basis on our spending habits.
That's right. I've known people, not worked with them, but known two people that have misused and mishandled debt consolidation. And you mentioned before that when your property values are increasing and your incomes are increasing, it can give you a fresh opportunity. But when those things aren't happening, and in particular when interest rates move up, when they fluctuate, that can put a family home under threat. I've seen two people lose or make that tough decision to sell the family home after inheriting a property. One was gifted, one inherited. They misused debt, and the best of advisors can't stop someone dashing out and getting another credit card or buying a car, purchasing something that long term they can't really afford. So it's a great opportunity for those that recognise it, and it's a really horrendous burden for someone that abuses it.
At least with mortgage brokers, with the massively extensive compliance they have to complete with every loan, and the reams of pages they need to put together to give to customers, they do need to spell out the negative aspects of a debt consolidation, and what has been discussed with the customer, as to the customer understanding the downside of a debt consolidation. And that needs to be in writing in the credit proposal disclosure document. But if you're dealing with a lender direct, they don't have to do any of that.
Yeah, scary stuff. But what a great episode with so many more scenarios for people to consider about how to increase your borrowing capacity. And that's what the show was all about. So on that note, it's a wrap for this episode of the Property Trio, and a huge thank you to Dave and your team and Mike for sharing their insights, and to Dave's team of strategic mortgage brokers and credit analysts at Property Planning for crunching all these numbers, which we will pop in the show notes. And good news, Dave's got some more tips and tricks to share, so we'll have another episode coming soon in our borrowing capacity series, and we'll be diving into interest-only periods and why choosing the right lender matters more than ever, especially when you're gearing up for your next purchase. But don't go anywhere just yet. Our gold nuggets are coming up.
Now it's time for us to go mining for our gold nugget property tip of the day.
Loves a good series, Dave, I've got to say.
Good one.
The RBA series that he did was a cracker. These are good because if you want to deep dive on a topic, you line them all up, and you're a cleverer person by the end than before you started. Dave actually triggered something that was going to be part of my gold nuggets, and that's the old idea about going to your bank lender, your bank manager, to see what you can afford. The reason why I was going to sort of take issue with that as a concept is it's so complicated, and you might be an analytical person, you could be an engineer or a mathematician, you could take, the value of extending a car loan out to 30 years and the opportunity value of being able to get an investment property. But if you're not like that, it's pretty complicated, and it changes from time to time, and it's different from lender to lender. Why people go to their bank to try and sort out their lending is beyond me. But then Dave just said, with all that compliance, if you go direct to the lender, they don't have to jump through all those hoops, all that red tape. That helps protect people that by default have very low levels of financial literacy. And I'm not sort of saying that as a me versus them. I'm talking about all of us. Unless you are in financial services, it's not really taught in school, but it's an area that you can get so wrong. And you elucidated that very well, Kate, by people that are forced to sell the home that they live in when they were basically sort of given two properties. That is getting it wrong, and it's a lot easier to do than what I think people might understand.
Yeah, look, that's well said, Mike. My gold nugget is just before you make any changes to your debts, or even to your employment status. So with debts, whether it's reducing debt, consolidating, closing facilities, you want to make sure you have a clear understanding of the implications and impact on your borrowing capacity, your purchasing power, your cash flow. You know, as we've touched on and showed in this episode, there are pros and cons to every move and decision. And without that full picture, you could unintentionally weaken your financial position and go down a path that's not best for you. So, yeah, as I've touched on, it really pays to make sure you discuss any of these changes with your strategic mortgage broker to ensure you understand the full picture before you make any of those big decisions.
I've got one quick little gold nugget. We chatted about debt consolidation, and it's a very powerful tool, but it can either be liberating or it can be a curse. And I don't say that to scare people. To make sure it's liberating and to get the optimal result for yourself, a good chat with your strategic mortgage broker will set you on the right path, because you'll have mortgage strategy. And that's, you know, really your roadmap that you can stick to, remain disciplined and know which debt is okay, which is healthy, and which ones you need to avoid.
Great note to finish on, Kate.
I think you did a really good job with this one. It was great.
So on that note, next week.
Yeah, we will.
Next week.
See you next week.